All right, guys, what's going on? This is Jerry Fetta, owner, founder, and CEO of Wealth Dynamics. I'm coming to you with a quick video today, a live stream, Sacred Account Saturday. We do these every Saturday, by the way. When I say quick, we'll probably be here for maybe 45 minutes to an hour. Actually deep diving on wealth building strategies using the Sacred Account. It's a life insurance tool that I've used for years. That's been around for, over a century and a half, a staple of the top 1%. And so I'm going to be talking today about how to use that. Now, before we get started, I do want to cover a couple of things that I always like to cover each week. And the first one is to make sure you have a purpose for being here, right? So if you're tuning in today, obviously there's a reason. And if there's not, it's going to be really hard for you to learn anything or apply what you've learned because there's not a purpose behind it, right? I went to a meeting earlier this week with someone, and about 10 minutes into the meeting, I had to stop the guy. I was like, hey, I don't know why I'm here. We're talking, this awesome, that's great. What is the point of this meeting? Like, what are we trying to get out of this? And that might sound, upfront or too frank or whatever, but the reality is for me is that I don't know the purpose of something. I know that I'm not going to be able to do well with it. I'm not going to win with it. I'm not going to be able to apply and implement it, right? So same thing with this. Why are you here, right? What are you trying to get out of this? What is this going to do for you in your life, right? The second thing is the idea that money is complicated and hard to understand. We need to throw that out the window today. Okay. That's something that we come up with as an excuse because we don't understand the vocabulary being used. And the reality is finances, it's just basic math. It's add, subtract, multiply, divide. And the only times it feels complex is when vocabulary that we don't understand gets added into it, right? And so Wall Street and banks tend to do that because they know that when somebody doesn't understand something, they generally are going to try and look for a professional that they can pay instead. And that is how they make their money. That's how they make their fees. Okay. So I want to make sure that that's something we understand is if I go over anything today, it's all basic math, right? None of it's complicated. None of it's too hard to understand. It can be learned. And that's a mindset we've got to have going into any kind of activity we're learning on, because again, if we don't think we can learn it, we're not gonna, and then we can't apply it. Okay. Second thing on the same point is the polar opposite. I already know this, I've reached the pinnacle of knowledge and there's nothing left to learn in life. And like this whole idea that I've heard this before, I've done this before, I've seen this before, I've read this before, dude, unless you're winning with it, you need to see it again, right? Like, why do you think I go to the gym every day? I'm not like, oh, I went before. Like, I'm good now. I went before. Or why do you think I take a shower? Like, oh, I showered before. I don't need to anymore. No. You do this stuff every day. The more you do something, the better you get, the more result you get out of it. And so same thing with finances, getting rid of the idea that we know it all, because no one knows everything. The one that thinks they do is the most ignorant of all of us, right? And also realizing that repetition creates certainty, right? The more I repeat something, the more I hear something, the more I see something, the more competent I actually get, right? So those are a few items I'd like to start with. Two more things. So first one is, if you are watching this and you do not yet have a copy of my book, Blueprint to Financial Freedom, it is my sole purpose for you today to have you buy this book and become a client of mine. I'm going to go ahead and show you what this looks like. And the reason why, guys, is you're not going to change your life on a webinar. Okay, I've been to tons of webinars. I've been to networking events. I've been to trainings, all of this, right? I've probably done a lot more than most people have. And that doesn't change your life. It gives you information for the period of time that you're there. And if you don't take it home with you in some way, shape, or form, it's not going to be something you actually see a change from. So the stuff we're going to talk about today, we're going to talk about for 45 minutes or so. And then you're back to your life. And unless you've got the data to learn more, right, to expand upon the knowledge you've got, unless you've got somebody to help you understand it, unless you've got somebody to help you implement it, chances are the things you learned today probably aren't going to happen in your life. Like, not to be like rude or anything, but it's like, I can't expect I'm going to become a financially independent, millionaire by watching a webinar once 30 minutes a week on a Saturday, right? It doesn't work that way. It's kind of like saying I went to the gym once 30 minutes a week on a Saturday. Sure, it's better than not going at all. But the reality is it takes more than that, right? So this is my book, Blueprint to Financial Freedom. Throughout this, I will be mentioning the book. You can go to jerryfetta.com/B2F promo. And this is actually free. You cover your shipping. It's like $8 or $10. Okay, you get the entire book. Not only do you get the book, you also get a free course supervisor. I have someone on staff. Their full-time job is to make sure that you read the book and you understand the book. Okay, most people don't finish books. I took responsibility for that. I said, they're going to buy it. They're probably not going to finish it because most people don't finish books. So I'm going to pay someone to help them finish it, to make sure that they do get through it, that they understand it, and that they can get the book done. Okay, and then the third thing you get with this, not only the book and the course supervisor, you get a free coaching call with 1 to 2 people on my team. Okay, it's either going to be Rodrigo Torres or Nano Aquino, and that's for the purpose of helping you implement the book, right? Because when I wrote this, I was like, A, it needs to make sense. It needs to be simple, true, and applicable. B, they need to finish it. So I'm hiring a course supervisor. And C, they need to be able to implement the information. If I'm reading this and I'm like, man, this is awesome, where do I go? What do I do? Right. So I wrote it so 1 of 2 things could happen. It is put together well enough that you could take it on your own and do it all by yourself with no help. Okay. I did that on purpose. So it's like, okay, well, if you don't want help, here's the info. Like, who am I to keep it from you? Right. You're probably going to find it somewhere, or you're going to go looking and find bits of pieces of it. And then it's going to screw you up even worse because you got, 40% of the information and the other 60%, random stuff or not even answered for you. So here's everything. And if you want help, there's a coaching call. You can work with my team. We will help you implement it. We don't charge for that at all. That just comes with the book. So on that note, I do want to introduce Rod Torres and Nano Aquino. And what I want to do really quick is actually bring each of them on just for a minute so that they can introduce who they are and what their goals and purposes are on the webinar today. And they'll be reaching out to you throughout. So I want to make sure you guys are connected up with them. So I'm going to put Nano on unmute really quick so Nano can just give a quick intro. And that way you guys understand who Nano is. Hey, what's up, Nano?
What's going on?
Oh, I can hear you now. Okay, good. I just wanted to give you a chance to just give a quick intro on yourself, introduce yourself to everyone as we get things started today.
Of course. Yeah. Well, first of all, thank you for the opportunity. For those that do not know me, name is Nano Aquino.
It's a little quiet, I think.
Oh, really?
Yeah.
I see here.
That's better.
Okay. Is it better now?
Yeah, that's better.
Okay, perfect. So as I was saying, thank you for the opportunity to allow me to introduce myself. For majority of the clients, if you've been a client with us, chances are you and I have spoken in the past. And if we haven't, my fault, right? So first of all, I was a client first. I started, working with you. I met you 2017, and I became a client November 2017 that year. And then I saw what Jerry was doing, and I literally sold everything that I had, and I moved across the country from Dallas to Alaska to work with Jerry. Just it was and he didn't have everything codified in the book. But anyway, I just saw what he was doing. I was like, I need this, but this is so powerful that I'm going to be changing my entire life to participate with this. So, and I have been submerged myself in this content, and thankfully enough, right, through a lot of persistence and learning, I can say that I have put, I'm going to consider myself an expert in this area, that I'm now allowed, can help many people to take time out of the equation with my expertise and, what I've done throughout the years to help them move along the plan a little bit faster. So that's a little bit on myself, my background, first as a client and now working with you full time for 4.5 years. And it's, actually a pleasure of mine to be able to help people throughout this process. So that's a little background on me.
Awesome. Very good. Thank you, Nano. So Nano's going to be reaching out to you. The next person I want to introduce is Rod Torres. Let me put Rod on unmute real quick so you can give an intro as well.
Thanks, Jerry. How's everybody doing? I know you can't speak back, but yeah. Yeah, I got into wealth dynamics over a year ago, and very much took advantage of all the tools that Jerry speaks about in the phases. I may have spoken to many people on the call now, but I had incredible results within the 3 months I was doing the program. Completely changed everything for me financially. I put everything to the test. It worked. It changed my entire perspective on finance. I then could not help but tell people about it. And because I had already been in finance as a profession, I decided to, this is where the truth lies about finance. This is where wealth building really occurs. It's not just some gimmicky thing. You actually build people's wealth this way. And am very passionate about it. So kind of like Nano, I dropped everything else and went full-time with Jerry. And I take calls at 10 p.m. I don't care what time it is, Saturdays, Sundays, it doesn't matter. Just because I want you guys to know how to take advantage the way I did and how to succeed with this program. And you will. You just do the steps, you'll succeed. And that's the 2-minute story there.
Awesome. Thank you, Rod. So if you're watching, Rod and Nano are going to be in the chat. If you have questions, reach out to them. They will be reaching out to you, especially if you're not yet a client and you don't have the book. So if they reach out to you in the chat, what they're doing is they're looking to set up a call with you. See if you're interested in the book, see if you're interested in setting up a coaching call, getting some help, whatever that looks like. And here's the thing, guys, you don't need to become a client. If you don't want to, that's fine. Our goal is not to make you do something you're not interested in. But if you're like, this makes sense and I would like help, maybe I could make faster progress. Maybe this is all brand new and I need some guidance and direction. Then that's what we're here for. Okay. But this is not a game of we want to convince you to do something you don't think you need to do or want to do. I'm not that way. When I go in and I buy things, I'm like, hey, here's what I want to do. Here's what it costs. Where do I sign up? And if I don't want to, I don't do it. Right. So same for you guys. So that's what the purpose of them is. That's the book. We want to get you set up with that. Now, today, what we're going to be talking about is building wealth with the Sacred Account. Really quickly, I want to give an intro on the Sacred Account just to give you a visual on this. And the couple of concepts we've covered before. But the first one is called the banking quadrant. Right. So in a bank, and I use the bank as an example because all of us use a bank. Right. So in a bank, we have depositors, we have borrowers, we have bankers, and then we have shareholders. Okay, these are the 4 different parties in a bank. Right now, basically, if you have a job here on this live stream, whether you're on Facebook, whether you're watching the replay on YouTube, whether you're on Zoom, it doesn't matter. If you're watching this right now, basically you're in a position where you use a bank, right? If you use a bank, then you are a depositor, no matter what. That's part of what you do is automatically your paycheck goes where? It goes to a bank. Okay. And so this is something I want us all to be able to realize, okay, we're already wearing the hat of a depositor. Now, what does a depositor do? We give the bank money. Okay. Why do we give the bank money? Because we're supposed to. That's where we keep the money. It's got to go somewhere, right? So we either have to bury it in the backyard, put it under the mattress, or stick it in a bank. Okay. So here's what we are getting. The exchange to us is right now in a bank account, you are making about 0.01% interest. Okay. This is what you're receiving, right? Now, what are you giving to get that? You are giving access to your dollars. Okay. Now, most people aren't aware of this. I wasn't until several years back that there's something called fractional reserve banking. Okay. Fractional reserve banking means when you give the bank access to your dollars and they pay you that very generous 0.01% interest rate that we get, they're taking your dollars and they're investing those dollars. This is a loan, okay? You loaned them your money, they're paying you interest. It's an unsecured loan. And the reason that is true is when you look at the balance sheet, the financial statement of a bank, their deposits are considered liabilities. They're not assets, they're liabilities. Why? Because they owe that money to the depositor, which means that is a loan. What is the loan secured by? Nothing. You're giving an unsecured loan to a financial institution for a loan rate, you're earning 0.01%. They're taking that money and they are allowed to loan out 100% of the money you give them. The reserve requirement on banks right now is 0. They don't have to keep even a cent of your money in the vault, right? So what are they doing? They're doing, loans to other people. The mortgage, that was your money. The car loans that someone got today, that was your money, right? The credit card that someone's paying 19% interest rate on, that was your money. Okay, not only that, but they're allowed to trade in the stock market and in foreign currency markets. Banks are basically allowed to act like hedge funds. They can aggressively trade and speculate with your money. So think about this. They're paying you 0.01%. And then they're using that money to make double and triple digit returns. Guess what the #1 profit center was for JP Morgan Chase Q4 of 2020, when we were all struggling with the pandemic and the recession and, you know, the craziness from the election and politics. JP Morgan Chase Bank had their most profitable fourth quarter in the history of their company, and their #1 profit center was foreign currency trading. They don't have any of their own money to trade foreign currency with. That was your money. If you have money with JP Morgan Chase, they're sticking it in foreign currency and they're making the most profit they've ever made and paying 0.01%. Okay, so everyone here is a depositor. You're just depositing it into another bank, not your own bank, that takes the money, they make money with it and pay you nothing. The other thing that you can be is you could be a borrower, right? So what happens with a borrower? A borrower, what are they getting? They're getting a loan. Okay, what are they giving? Sometimes they might be giving a down payment, right? But the main thing that they're giving is income and interest over the period of that loan. Okay, so here's the thing you have to rework. This loan was not the banker's money. This loan was the depositor's money. So the banker is taking the depositor's money and giving it to the borrower as a loan. The borrower is paying usually some kind of a down payment to the banker and paying income and interest for the period of that loan. If it's a mortgage, that's 30 years. If it's a car loan, that's 4, 5, 6, 7 years. I've even seen 9-year loans now, right? So the banker is making down payment money, getting income from the borrower, getting interest from the borrower for putting at risk the deposit. Right? Like, this is actually how it works. I want to stress this because when I saw this, I was like, that is so messed up. Right? So the borrower is, you know, and with the loan, the borrower could make money, right? Like, what the borrower does with the loan is up to the borrower. So the borrower could definitely take a loan and go make a good financial decision. They could buy real estate. They could invest. They could grow their business. So the depositor is getting screwed. Like, there's literally nothing good happening for the depositor. There's no benefit there. With the borrower, you get to use the money. And as long as you can make more than the interest costs, it's in the hands of the borrower to be wise and be a good investor. Okay. Now, what about the banker? The banker is orchestrating this, right? The banker is marketing to get incoming deposits, and then he's taking those deposits and he's loaning them out. He's investing them in order to grow the bank. And what does the banker make? He typically makes a percentage, right? So if he loans this out, let's say at 5%, and he is paying 0.01%, right? His spread is 4.99%, right? And you might look at that and you're like, 4.99 is not super high. Yeah. But when you look at it from a standpoint of like, what percentage is he making on 0.01, right? Like, how many times does 0.01 go into 4.99? Let's look at that really quick. So we have 4.99 divided by 0.01. That's a 499% return with none of his own money at risk. When you take 0.01% and you make 5% and your cost is just that 0.01%, that's a 499% return on not even his own money. Nothing of his is at risk, right? So can you see why banks do this? This is a phenomenal return. This is not only triple digits, this is like stupid triple digits, right? So that's the banker. So think about, how many people do you know that are depositors? Pretty much everyone. How many people do you know that are borrowers? A lot of people, but not everyone. How many people do you know that are actually bankers? Maybe zero. Maybe you can count it on one hand. Like, how many literal bankers, like people that run a bank, do you actually know in your life? Okay. Now, the next part is the shareholders. The shareholders, they get dividends. Right? So this is the exchange. Now, I want to point out the banker is getting the exchange of receiving 499% return. He's giving up nothing. Do you see how that's out exchange? That's completely out of balance. He's putting nothing at risk. He's putting nothing into the deal. He's providing no value. In fact, he's actually giving you a lot less than he could on your return on your savings and your checking account. And in exchange for that, there's about a 500% return that he's getting. Okay. Now the shareholders get a dividend. Okay. A dividend is a percentage of the profit from the bank. Okay. So that's what they're receiving. Okay. And then the other thing is they're giving up typically investment capital. Generally, a shareholder is a shareholder because they bought ownership in the bank or they provided money to start the bank up. And so that's why they get dividends. They're an investor. So when the bank does well, the shareholder gets a dividend, right? So before I talk about how this works and how you can do this, the average person has zero way to become a shareholder in a bank. The average person has zero way to become a banker. The average person does have a way to become a borrower, but typically, this is not the best way to borrow. I'm going to show you the best way to borrow today. And the average person is basically forced to become a depositor, right? Like try going to a job and then they're like, where do you want your paycheck sent? And you're like, nowhere. Just send me the check and I'll figure out how to turn it into money without using a bank, right? It's impossible. You can't do it unless they're going to pay you cash under the table, which most companies aren't going to do unless you're maybe in construction, maybe in some of these things where you could pay cash under the table and it would be totally normal to do, right? But here's the thing. If we go back to our quadrant, we have depositor, we have borrower, we have the banker, and then we have the shareholder. Okay, what if you could be all four? Okay, like think about this. What if you could be all four of these roles? Like you didn't have to be just a depositor. You didn't have to be just a borrower. You didn't have to have the banker take advantage of your money like this, and you could actually grow it yourself. Okay, like the depositor would be you. And in this case, we're using something called the sacred account. We're using life insurance, right? So I want to talk first about this just as a deposit account, right? So with life insurance, here's how this works. When you put money in, your money is going to grow at a 3 to 5% interest rate. Okay, 3 to 5% interest rate. Now, we just said that you're making 0.01% at the bank. So let's say you're making 4% on your life insurance policy, because that's the middle ground between 3 and 5. So how many times does 0.01 go into 4%? So 0.01. So we go 4% divided by 0.01. That's 400 times higher return than you're going to get at the bank. Okay, so you're setting up an account that's making you 3 to 5%. And that's 400% more than the bank is going to pay you today, right? And that money is going to grow forever at that 3 to 5% rate. It's guaranteed to grow. Not only is it guaranteed to grow, it has for the last 150, in some cases, 160, 170 years in a row, right? Like it's one thing to be like, we guarantee this. It's another thing to be like, I guarantee this. And also I've done it for 170 years in a row. Right? Very different conversation. Anyone can guarantee something. Anyone can talk big and say this is going to happen and da, 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 da. But what is the track record? Right? We're saying this has happened, like not for 5 years, not for 10 years, not even for 50 years, not even for 100 years, 150 years, 160 years, 170 years in a row. Okay. So it's guaranteed to grow. It's also guaranteed not to lose money. Right. And again, it's not only guaranteed not to lose money for 170 years in a row, it hasn't. Right. Like we're talking, when you think about this, think about what's happened in the last century and a half. We had an actual civil war, right? Like literally we had the country divided in two and the North and the South were fighting. These guys were around back then and paid a dividend, right? We had the First World War. These guys were around back then and paid a dividend. We had the creation of the Federal Reserve Bank. These guys were around before the Federal Reserve even existed, right? Like when banks were going bankrupt in the early 1900s, these guys weren't. They were around and they were still making money and they weren't losing. Okay. We had a stock market crash and then followed that by the Great Depression and a Second World War. Like this is why, like on the news, when people are like, everything's so bad, you look at the 1920s, 30s, and 40s, that wasn't good. That was like a period of like 20, 30 years where, we have a stock market crash, we go into a Great Depression, we then have a world war, and then the 1950s comes around and we're in another recession. That's a big window of time of bad things happening on a very large scale nationally. All of that occurred. These guys still paid dividends. They still made money and they still didn't lose. Right. And then you fast forward a little bit, you get into like the 80s. We had, the stock market crash in the 1980s. Again, these guys made money and didn't lose. The tech bubble happens, right? Well, almost wipes people out. These guys didn't lose a cent and they still made money. They still paid their dividend. Okay, the mortgage crisis happens. Like we literally have people, like hundreds and hundreds of millions of people are affected by that. Foreclosures everywhere, banks going under. Like some of the largest banks in the world went under. These guys didn't. They didn't even lose money and they still paid a dividend, right? 2020, they still didn't lose money. They still paid a dividend, right? Like this is not like, oh, it's a great track record. It's like, no. This is like every single thing that's happened for the last century and a half, they were untouched. Okay, that's a guarantee, right? Nano says Americans losing 50 to 60% of their investments. Not only did you not lose money, you got paid. Yeah, like in 2020, who remembers in March of 2020 when the stock market tanked? Right, I do. I looked at that and I was like, the stock market just tanked and I still made my dividend. So not only was I not involved, I still made money, right? In the financial crisis in Europe and Greece, they did what was called a bail-in. This was, I think, in 2011. If you deposited money in the European banking system in Greece, they limited your withdrawals to, I believe, it was either $25 or $35 per day. That was the most the bank would let you take of your own money from the account. Okay, so not only are you getting nothing for interest, they can lock your money up, right? Why? Because it's an unsecured loan with a 0.01% interest rate. Technically, all they got to do is pay you the interest. Anything else above that is a favor, right? So I don't like that system. So instead of depositing it in a bank, instead of depositing it into a checking account, you deposit into the sacred account, guaranteed to grow, guaranteed against loss, can't be taxed. Okay, there's no volatility with markets. There's none of that. It's protected from taxation. It's protected from lawsuits. It's protected from creditors. Like there's so much stuff that you can do with this that you can't get with the bank. It's even insured at a higher level than the bank. When I get FDIC insurance, I believe that's only $250,000. With my life insurance policy with the Guarantee Association that backs it at the state level, I believe it's $400,000. Right? Not only that, but every single dollar that I have in my cash value is backed by actual reserves. Like it's literally actually there. You know what I mean? In cash. Like it's not like they're loaning it out to other people and they don't actually have it. No, it's there. They're required to have that money there. Right? So as far as a deposit account, this is a much better way to go. Okay. Now let's talk about the loans. Let's talk about what this looks like if I'm a borrower. Right? So the depositor, we're making 3 to 5%. Right? Now, part of this 3 to 5%, let me go ahead and actually clarify this, because part of this is going to be with a shareholder as a dividend. Part of this is going to be as a depositor with interest, right? So the interest is typically going to be, let's say the net rate is maybe like 1 to maybe 3% interest. Okay. And this is out of this 3 to 5. So of this 3 to 5, the first 1 to 3 of it is an actual guaranteed interest rate. Like I'm going to get this no matter what, it's contractual, right? Now, my total rate that I'm earning is 3 to 5, and I'm going to skip ahead a little bit. That's because I earn dividends as a shareholder. And the dividends are typically an additional 1 to 2% per year on average. Okay. Above and beyond the guaranteed interest rates. Right? So what's a 3% guaranteed rate plus a 2% dividend? That's 5%. That's where this 5% number comes from, right? If I'm making, 2% dividends and I make 1% in guaranteed interest, that's the 3%, for example. So that's where that total number comes from. But as a depositor, this is the portion of that total return that's guaranteed interest. Now, I can borrow from my policy, right? My cost to borrow is generally going to be a net effective rate, NER, net effective rate of about 1 to 3%. What does net effective rate mean? It means that's the actual dollars I'm paying in interest, because I'm going to be doing things like paying loans down, writing things off on taxes. And so when I factor all of that in, my gross interest rate might be 5%, for example, but I'm not actually paying 5%, because if I borrow for a real estate deal, the income I get from that real estate deal is going to pay my loan off early. If I borrow and pay off debt, the minimum payment that I freed up now because that debt no longer exists, that's going to go towards paying my policy down, right? If I'm borrowing to, let's say, make a large purchase like a car, for example, well, I'm going to make myself a car payment. I'm going to pay my loan back, right? And the reason why is because I am not borrowing from someone else. I'm borrowing from myself, which means I'm also the banker. Okay. So here's the thing. When I borrow and I pay this 1 to 3% interest, I still make the 3 to 5 like my money never left. Okay. And I want to point this out. When I buy an asset, and that asset is either earning income or it's appreciating in value or it's growing, when I sell that asset, two things happen. Number one, I sold it. I can't have the growth of it anymore because I don't own it. I sold it. I got rid of it. So I don't personally like selling assets. If you study the wealthy, when things are stable and real and they earn income and they grow, the wealthy don't sell those assets. They hang on to them, right? It's like the golden goose. Like, why would you slay the goose that lays the golden eggs? Just keep getting the eggs. And I ideally figure out how to get more of those geese, right? So I'm never going to sell an asset that's growing that I know is stable and I know it's going to continue to grow. I want to keep those for a very long time. You know, for me, like when I have my life insurance, I never plan on getting rid of it. My gold, I never plan on getting rid of it. My real estate, I never plan on getting rid of it because I can just go earn more income and buy more of those things, right? So when I sell, I lose the thing, I lose the asset, I lose the growth of the asset. And if the asset went up in value, I pay taxes on the profit. That's called a capital gain. Okay. So two of the worst things in the world for me as an investor, losing an asset and paying taxes. Like those are literally like my least favorite financial things in the world. I hate paying taxes and I hate the idea of losing an asset. So when I sell, I am initiating both of those things to happen to me. So rather than selling, I borrow. Why? Because when I borrow, I keep the asset, it still grows. So when I pay interest on a loan on my own cash value, I still have the money in there. It's still earning 3 to 5% like it never left. Didn't sell the asset, still getting the growth. The second thing is I don't have to pay taxes on it because the IRS can't tax a loan, right? And that's not even just with life insurance. I can do this with gold. If I have gold and I buy it for 2,000 an ounce and it goes up to 2,500, if I sell it, I'm going to pay taxes on the 500. If I take a loan, I pay zero taxes because it's not a sale. It's not a profit. It's not realized. The IRS can't touch it, right? So I would rather borrow. I can borrow against houses. I can borrow against life insurance. I can borrow against gold and silver. You can borrow against stocks. You can borrow against bonds. You can borrow against pretty much anything that could be used as collateral, right? So I'm going to play that game with the life insurance. Now, the benefit of doing it with life insurance is life insurance can't lose money. So let's say I borrow against stock. Well, if the stock drops and goes down in value, all of a sudden, I'm no longer backing my loan with enough stock. And the bank is saying, Jerry, you borrowed this much money based on your stock and your stock is worth half that. You need to pay us today or we're going to sell your stock at a loss and take everything, right? That can't happen with life insurance because life insurance can't go down in value. There's never hey, the account went down and you need to pay it off sooner. That's impossible, right? So it's a very safe thing to borrow against compared to other asset classes. So when I borrow, my cost, my net effective interest rate is going to be about 1 to 3%. I'm still going to be making 3 to 5%. And as a borrower, I can go do smart things with this money. Okay. Now, as a borrower, when I take a loan, I'm looking at a few things. I'm looking at, okay, could I pay off some debt with this? Do I have consumer debt? If I have a credit card at 18% interest and I can take a loan against my life insurance and pay that credit card off and save on interest and free up that income and be able to pay myself back, that's a smart financial decision, right? If I've got, let's say 40 grand in cash value in my life insurance and I was going to go buy a car, rather than financing it with the bank, rather than using, my cash and basically turning 40 grand into 20 grand over the next 5 years, I'm going to take a loan against my life insurance. I'm going to buy the car with that. I'm going to make a car payment to myself. And at the end, I'm going to have a paid off car. My cash value will grow like it never left. And I have more money than I started with. Okay. As a real estate investor, I borrow and I go do real estate, same thing. I can go earn passive income on that real estate. It's going to pay myself back over time. And in 5, 10, 15 years, whatever my timeline might be, I've got the real estate, I've got all the income I've earned and my cash value grew like it never left, right? So as a borrower, this is over here. I'm able to pay off debt. I'm able to make purchases, large purchases, like self-financing these things, and I'm able to invest by taking loans against this. Now I'm also the banker. So as a banker, I'm going to require repayment of loans. And I'm also going to charge myself interest, right? Because I am the bank, I am the depositor, and I am the borrower. Imagine if the bank was loaning out their own money, right? Because you are like imagine how much more financially responsible a bank would be if it wasn't them taking the money from some random depositor that they know that they're going to make a 500% return on, and they've got no risk and they've got no responsibility. And it was actually their own cash. Like the banker had to include his own cash every single time he did a deal. He would be more responsible, right? He would not be as risky. He would be charging interest. He'd be making sure people repaid, right? So when I'm the banker in this scenario, and this is where you have to be able to be like pretty fluid with your thinking. Like you can't just be, I'm a depositor. And then it's like, so why would I pay interest on my own money? No. I'm a depositor. That's one hat that I wear. And I'm a borrower. And that's another hat that I wear. And I'm a banker. That's another hat that I wear. I'm wearing 3 hats. We're about to talk about a 4th one here. So I have to be able to think with the viewpoint of each of those 3 people. When I'm a depositor, what do I want? I want to know my money's safe and I'm earning decent interest on it. That's covered. When I'm a borrower, what do I want? I want to know that I can, borrow money and it's got a good rate and the terms are advantageous and I can go do smart things with it. That's there. When I'm a banker, what do I want? I want repayment and I want interest. Okay. So I am making sure I repay my loans to myself, even though I'm the borrower and the banker and the depositor, and I'm making sure I'm paying interest because I'm the borrower, the depositor, and the banker. It doesn't change just because I'm wearing all of the hats, right? Now, the next one is the shareholder. So there's the shareholder, I earn dividends, right? Dividends are a percentage of profit in the insurance company, right? So as a banker, it's like I have a partner, and that partner is the insurance company. Right? So if I have a policy with Guardian, let's say, Guardian's my partner in this deal. When I do policy loans, it benefits both me and Guardian, right? When I put money in my life insurance policy, it benefits both me and Guardian, right? We are partners in this deal. I want them to win. They want me to win. It's a mutually beneficial relationship. As a shareholder, Guardian pays me a dividend. They pay me a percentage of their profit. Every single year, they issue it, like probably in the next 6 to 8 weeks, they're about to issue what the 2023 dividends would be. And they issue their dividends and I get a percentage of that. And that percentage is based on the fact that they were profitable and they were a good partner, right? So I'm over here as a borrower, I'm making profit on what I do with the money I borrow. I'm over here as a depositor, I'm earning my guaranteed interest rate. I'm over here as a banker, I'm earning repayment, I'm earning interest, right? And then I'm over here as a shareholder, a partner with Guardian, earning dividends based on the profitability of the organization, right? Here's the thing. Here's the reason why, another reason why I don't mind paying interest to borrow, right? We already talked about the benefits. I avoid having the taxes, the money keeps growing, but here's another thing. The interest I'm paying is going to Guardian. Who owns Guardian? Me. If you have a policy with Guardian, you're an owner, you're an equity shareholder in the company. So it's like, all right, I'm going to borrow money. Like we already know that if we all were to go and look at our life of all the loans we've ever taken and all the interest we've ever paid, it went to third-party financial institutions and you had 0 benefit in the financial upside of that loan with the interest being paid. Okay, so what we're telling you is you're already paying interest, right? So pay it on your sacred account instead to a company you're part owner in and you financially benefit. It's like if I have a gas station and I sell gas, right? I also buy gas if I drive a car that takes gas. So when I buy gas, am I going to go to the other guy's gas station and pay him money? Or am I going to go to my gas station where, yes, I will pay for gas and I will pay the retail price, but it all flows into my company and I benefit and I get a percentage of that profit. Okay, I'm going to do number 2. Same thing. If I own a grocery store, right? I own a grocery store and I want to go buy apples or produce. Okay, sure, I sell apples or produce. But am I going to go down the road to someone else's grocery store because I'm not going to pay money on my own apples? That's stupid. So I'm going to go pay it to someone else and get no benefit. No, I'm going to go to my own grocery store and buy my own apples and my own produce from myself. And I'm going to pay the retail price. And sure, I had to pay for apples, but I was going to anyways. And I benefit from it because I own the store and I get a percentage of that profit, right? That's the mindset shift we have to make. We've been trained when we take loans, we take them for things we don't currently own, right? Think about it. When you take a loan for a car, it's because you don't own the car and you don't have the money and you're trying to get the car and you're willing to pay interest to a bank to get something you don't have. With a house, same thing. You take a loan on a mortgage to get a house that you don't currently own. And by the way, you won't until you pay off the title. And even when you do, stop paying the property taxes and find out who really owns that thing, right? All that aside, I don't own the house and I'm paying on that mortgage and I'm making that loan because I don't have an asset. I don't have the money. I'm telling you, flip it, because that's what the banks are doing. You're putting deposits into a bank. They own the asset of your deposit. Now, that was a loan. It's on their balance sheet, right? Sure, it's a liability. They owe it to you, but they have the money and they are borrowing against your deposit to go invest. They're not using it to buy cars. They're not using it to finance houses they're going to live in. They're not using it to pay for college. Okay, they're loaning it out to other people to have them do all those things. Right, so this is how you make money on this. I'm going to show you a fourth and fifth way now. Sorry, no. Sorry, a fifth and sixth way. So we had the depositor, the borrower, the banker, the shareholder. So as a borrower, I want to show you two ways to supercharge this as an investor, as a borrower. So I did the deposit. My money's in the sacred account. It's growing at 3 to 5%. I borrow against it. Let's say I'm paying 2% in interest. That's my net effective interest rate. You know, I'm earning the dividends. Everything's going really well. What do I do with the money that I've borrowed? Okay, so I want to share this idea with you. So this is called, oh, that's not the marker I wanted to use. So this is called seller finance real estate. I'm about to blow some minds here. All right, so let's just use this as an example. Let's say that I have 150 grand in my sacred account. So this is step one. I've got 150 grand in my sacred account, right? Now this is growing at 3 to 5%. And step number two, I take a loan against it. So I'm borrowing my 150,000 of 150, so a loan of 150K. And my cost is, let's say, let's change this a little bit just so we deal in certainties. 3 to 5%. Who can agree that the difference between that, the middle ground, is 4? Right, so let's just say I'm earning 4%. And my interest cost is 1 to 3%. We can all agree the middle ground between that is 2%. So I'm borrowing at 2%. My money is still growing. My 150 grand is still growing at 4%, like it never left. And I'm paying this 2% cost. So the question then becomes, what do I do with the 150 grand? So if I do seller finance real estate, I have 150 grand. Here's what this is going to look like, right? So I'm going to be able to buy 3 homes. Let me put my screen away here. I'm going to be able to buy 3 homes with 150 grand. Okay. Now I'm going to pay for each of those homes, let's say $45,000. Okay, $45,000. Actually, let's say, just to keep the math easy on this, let's say I did pay 50 on each. You know, 50,000 times 3 is 150 grand. That's going to make the math even and easy. So I put 150,000 in. I got 3 homes, which equals $50,000 per home. Right? So I have 150,000 in my sacred account. Growing. It's there. That's an asset. It's producing. I now have also $150,000 worth of real estate. I own 3 homes now. Now, seller finance real estate works like this. These homes we're going to put on market and we're going to sell them usually for 20 to 30% more than we paid. So if I paid 50, I'm going to sell this for 1.25% more, or sorry, times 1.25 times more. So I'm going to sell each home for $62,500 on a seller finance contract. Okay, what does seller finance mean? It means that I'm going to collect a down payment from somebody. They're going to move into the house and they're going to make a monthly mortgage payment to me based on the price we settled on. In this case, $62,500 each. So one thing just happened, and I want to make sure you didn't miss it. I put in 150,000. As soon as I sold all 3 of these homes for $62,500, this 150,000 is now worth $187,500. Why? Because the value of this loan is the new asset. The home is the collateral. It's the thing that backs the asset, but the actual asset is now this $62,500 mortgage loan that I have with the family living in the home, which means my asset value just instantly went from 150,000 to 187,500. I've increased my net worth by 25% almost instantaneously in the amount of time it took me to get those properties occupied, which could be 3 months, 6 months, 9 months, around that range. But that's a 25% step up in equity, right? Now, the other thing that's happening here, this is seller finance. So they're making a mortgage payment to me. I'm charging 12% over 240 months. And so I'm making, check this out, 12% on 62.5. Well, each home, how much did I say I put in? I said I put in 50. So I have on one home, for example, principal of $50,000, but it's earning me income as if it was $62,500. Okay, that means that my yield, my annual yield on this, my cap rate, I think the average on this, if we look at a mortgage calculator really quick, 62,500. Let's say I collect a down payment of $1,500. My interest rate is 12%. So I'm bringing in on this example about $671 a month as a mortgage payment, right? So $671 a month times 12 months is $8,052 per year. That's my income on this one property. I have 3 of these in this example, $8,052 a year. $8,052 a year divided by my principal. So divided into 50,000 means that I am earning a 16% annual rate. That's my annual yield on this. Now, I'm not saying this is guaranteed and how it always works, but this is an example of how it can work, right? So I have 3 homes, 150 grand I put in. I seller finance each of them for 25% more than I paid. That's 62.5 each. So now I have 3 homes with notes of 62.5. My value is 187.5, and I'm making $8,052 per year per home, right? $671 a month per home. So I have 3 of those. What is that per month? About $2,000 a month. Right? So I'm making about $2,000 per month. I just increased my net worth already by 25%. My yield is 16%. And I still have my money in my sacred account all the way up here where we were talking about this earlier, earning 3 to 5% like it never left. This is how wealth is built. This is how banks do it, guys. They're using your deposits. That's this money, right? They're using it to do things like mortgages. Banks, mortgages, it's synonymous, right? So we're not telling you to go do something that's unproven or speculating or whatever. This is literally what is happening. If you live in a house, this is happening to you right now. Like you are using the bank's money, which is really someone else's deposit, to borrow, to buy a house, to make a mortgage payment to them that they're making gigantic returns on. Right? So I wanted to bring this up today because this is like we've talked about private lending, we've talked about sacred accounts, we've talked about all these things. This is the best way to do it because on seller finance, I have direct control over the property. My name is on the title. I have the deed. And so until they pay that home off, I have the ultimate protection because if they default, they miss a payment, whatever might happen, I always have the home there. There's not other investors involved in the home. That's not a pool of money. No, my money went into that house and that is my house. Right? And I have someone that lives there and they're making a mortgage payment. Right? That's the extent of it, right? So I know we covered a lot. I know this was maybe a little bit complex. I do want to open this up for questions. I apologize. I meant to go over. I usually do go live and answer questions. So as you're watching this, questions that might come up is, maybe concepts I went over, phrases that I used that you would like for me to clear up and understand. So type those in the chat. The other one could be just like clarifying what we just went over because we covered a lot of stuff today, right? Like the bullet point version of it is we're putting the money in the life insurance. It's growing at 3 to 5. We're borrowing at 1 to 3. We're putting that into seller finance real estate where we sell it for about 25% more than we bought it. And we finance that balance, 12% interest over the next 20 years. We're earning a very strong yield and we have an increase in net worth. Okay. For those of you guys that are like, I want to become an accredited investor, what better way than to bump your net worth up 25% immediately by seller financing a property, right? And also still have the money growing in life insurance. Okay, so I'm going to go ahead and just answer some questions. Definitely drop those in the chat. Okay, so we have a question here. What do you have to do to achieve wealth through steps? So I'm not sure I quite understand that one. So we have a book, the book here, and I'll pull it up again, Blueprint to Financial Freedom. And it does have steps, right? And everything has steps, right? Being broke has steps. If someone were to write like, here's the checklist to follow to be broke, it would be like, don't work, put everything on credit cards, never save, be lazy, be financially illiterate, don't study money, don't invest. Like you could follow that checklist in sequence and it would create the state of poverty, which means also a checklist exists that creates the state of financial freedom, wealth, abundance, right? So again, if you're watching this and you're like, what are those steps? Go to jerryfetta.com/B2F promo. And you can get a copy of my book there, and that'll walk you through the steps. Very important to note, guys, I'm 30. I did not come up with these steps. I spent the last 10 years of my life studying, financial institutions, Wall Street, banks, the top 1% historically. And I looked at what did they actually do? And the steps are what they actually do. I just decided I shouldn't take everyone 10 years to learn this stuff. So I'm going to put it in a book where they can just have it right away. Okay. If you want to go figure it out and spend the next 10 years, by all means, I'm not going to stop you, but that's what the book is about. So good questions there. Comment here. Not all banks give dividends. That's true. And not all insurance companies give dividends either. That's why you have to work with the right ones. And that's the importance of working with my team on it as well. And then really quickly, before I dive into any more questions, if you got a chat message from Rod or from Nano, be sure you check your chat, set up a call with them. Okay. I want to make sure that, if you don't have a copy of the book, you get that. If you didn't do a coaching call, you do one. If you did one already and you want to do another one, do one again, right? They want to talk with you and help you. Lots of good questions here. All right, Andrew, good to see you. Kim, good to see you. Tom, good to see you. Lawrence, good to see you. All right, Jamie has a question here. Let me bring Jamie on. We have a question from Jamie on some tax stuff, looks like. All right, so we should be able to have the mic unmuted for Jamie here in a second. All right, Jamie, I just unmuted you. Let me know if you're able to unmute the mic and we can answer your question. If not, I can read it too. All right, so I'll go ahead and read this one. So Jamie's question, are you able to write off interest on your taxes when you take a loan from your life insurance policy? The answer is it depends. So if you're using it for investment purposes, if you're using it for business purposes, then the answer is usually going to be yes. You do want to work with your CPA on that as well. If you're using it for personal, like let's say I'm paying off a credit card, the answer is probably no, right? Like that's not going to be a reason. It's not tax deductible. It's a personal expense. So very similar to regular, any type of expense. If it's used for business, if it's used for investing, you can very easily write it off. If it's not, then it's very hard to justify a tax deduction. Lauren says this illustration is powerful. Absolutely, I agree. Let's bring Avery on. Avery has a question here. Hey, Avery, how are you doing today?
Hey, what's up, Jerry? Doing great today. How about yourself?
Hey, I'm doing phenomenal. You have a question on just property management and the numbers?
Correct. So with all of the math that was worked out, would you have already worked out the math in terms of property management, or is the family that's moving in responsible for all of the maintenance and such?
Yeah, that's a great question. So on seller finance, it is a mortgage. So for regular things like, taxes, insurance, utilities, maintenance, repairs, the family is responsible for all of that because it is a mortgage. So they're just like if I have a mortgage on a house, the bank's not going to be like, hey, you broke your washing machine. Let us help you fix it. No, I have to go fix that myself. Or, let's help with your utilities. We'll cover water. No, I pay all of that because it's my place, right? So the family, they cover all that. Now, as with this investment, I do pay property management for management of the family themselves, making sure they make their payments, making sure the money gets to escrow, making sure the taxes get covered, handling any foreclosures and evictions if that comes up. The cost on that and on this particular program that I use is $65 a month per property. So it's not that bad. You do want to factor that into the numbers. Today I covered just hypotheticals. So those numbers aren't included. Someone could certainly do seller finance all by themselves with no management. For me, I'm busy. I want to have my company expand. And so I'm not really interested in like managing escrow accounts and stuff. So I'm willing to pay the $65 a month for that. The other thing to factor into the numbers is vacancies. So on the portfolio that we work with, generally the actual foreclosure percentage is about 7% of the portfolio. So you want to factor those numbers in as well. So that might lower it down when you look at, okay, I've got some property management costs. You know, I've got a few foreclosures that might happen, which results in vacancy and payments not coming in on a couple homes. And that's going to maybe lower the numbers down a tad bit, but it's still going to be up in that range. So like on the actual homes, I think in last quarter of this year, the annual yield was like almost 14%. And so when you factor in all those costs, you know, it might bring it down by maybe 2 or 3% per year, just depending on those factors. All right, Christo asks, which life insurance companies are best to get a policy with? So they're all designed a little bit different, Christo. So what I would do is I would reach out to Nano or to Rod on my team. Personally, I have my policy with Guardian Life, and the reason why is Guardian has a very user-friendly interface. They've been around for a very long time. They've got a good dividend rate. They've got riders that other people don't offer. And they also allow me to put money in unscheduled. Like with a life insurance policy, you're going to commit to a monthly amount that like, no matter what, I'm going to do $500, for example, right? Now, Guardian says, well, that's great. But also if you want to put in more, you can dump in extra whenever. Whereas other companies are like, well, if you want to put in more, you've got to wait till your policy anniversary date, and then you have a 60-day window to send it all in, and you can't put anything else the rest of the year. I don't really like that. So I like the Guardian system with that as well. Alcatel says, wanted to say hello. I'm finding this very interesting. Awesome. Well, be sure to reach out to Nano here or to Rod. So Nano has a question from a client. He said, I had a client asking me about length of contribution. Can you cover the advantage versus disadvantage of the premium versus the light? He's 55 years old, no debt, $3,500 a month, $5K monthly as options. Yeah, absolutely. So the light account has a totally different purpose. So when we design the life insurance, there's two different designs that we do. We call one of them is the light. The other one is the premium. Okay, the light is designed for getting rid of consumer debt. Right? So on this one, what we're focused on is we're focused on higher liquidity. And the way we accomplish that is through a shorter contribution period. So the way that a life insurance policy works is I could set it up to contribute my entire life if I wanted to. But if I shorten the contribution period and say I'm only going to contribute for like 7 years or 10 years, it front end loads the cash value even higher. So I might have, you know, let's say, you know, 85% liquidity, meaning if I put in 10 grand, I could pull out $8,500 tomorrow. And the reason why I would do that is because I have consumer debt that I want to pay off. I want as much money as I can available today to be able to pay off that debt. Now, the trade-off is that the internal rate of return, the IRR, is lower. And I've got that shorter contribution period. I can't put money into this after the 7 to 10 year period. So whatever that cutoff date is, no longer contribute. Now, it doesn't mean the policy goes away. It's still there. I can still borrow against it in the future. It's still going to grow. I just can't keep putting money into it. So this is really good for someone that has consumer debt, because if I have debt, my concern is getting rid of the debt, not necessarily the internal rate of return on my life insurance policy. Now, the premium account is for somebody that has no debt. This is going to be more for building reserves and also for investing. Okay, this still has high liquidity. Like we can still get the liquidity between 70 to 90%, but apples to apples, you're going to get more liquidity on this kind of account than on this one, right? Contributions generally are going to be 20 years or more. Okay, and then it's got a higher internal rate of return. And then it also has some extra riders that aren't covered on the light account. So this is really good for someone that has no consumer debt. They're like, hey, I want to maximize my return. I want to fund a lot of money into it. And that's the other thing, is the contribution amount is lower on the light. On this one, On the premium, the contribution amount is higher. You could put in more money, right? So on the premium, I've got no debt. I've got lots of cash flow. I'm looking at building reserves. I'm looking at investing. I may be looking at making large purchases. I want to put the money in long term. I want to maximize my internal rate of return. I want to put a lot of cash into it, right? And I'll be totally honest, when I had debt, this was not a financial option for me, right? Like I wasn't like, I've got all this cash flow and I'm looking to invest. It's like, no, I have a credit card with Visa and I'm trying to get rid of it. And I need to be able to do that. And I want to do it in the most financially smart way. So that's where the light account made sense for me. So I hope that kind of clears that up. We do have a couple illustrations that Nano can go over with you if you're watching. Good. And again, reach out to Rod, reach out to Nano, check your chat if you guys have not connected with them. Nano says this client wants to contribute a maximum of 10 years and doesn't want to have to contribute for 20 years. Okay, let's go back to this really quick. We're still on this topic. So on this one, you can, and this is optional, you can shorten your contribution. So you're saying, I plan to do 20 years. You can do 20 years. At 10 years, you could say, hey, never mind. It's called reduced paid up. Reduced paid up additions. I'm going to basically shut the contributions off. And that way I don't have to put the money in, which is different than the light. The light account, you cannot contribute for more than 20 years. There's not for more than 10 years. There's not an option for it. With the premium, there's an option for it. And also you have the option to say, hey, let's stop it at 10 years. I'm in retirement and I don't want the commitment of putting money into the account anymore. So premium, a little bit more flexible. I could keep it as a longer one. I could shorten it. The light, less flexible. I cannot lengthen it and it's going to be for 7 to 10 years. And that's that. Good questions. Okay, good. Let me just check really quick if we have any other questions before we wrap things up here. I think that we covered them all though. Good. Yeah, I don't see anything else on questions here. So guys, what I want to do is just wrap things up. Again, if you have not gotten a copy of my book, one more time with this, I know I'm going to just beat the dead horse here, but go to jerryfetta.com/B2F promo and get the book for free. Again, you get the book, you get all of the material we covered today, plus more. Like this is enough for you to just go implement it if you wanted to. And you get a course supervisor to make sure you understood and finished the book. And you get a free coaching call with my team to implement what you've learned. Okay. No one else is doing what we do, especially even just with a book. Like who else do you know that does that when you buy a book? So if you do not have the book, get the copy. If you have not set up a call with Rod or with Nano, reach out to them in the chat. And then before we wrap up on Monday, we are going to be doing another call with Nano. It's Money Monday. I think Nano's still in the book Liar's Poker, and this is all about Wall Street, right? So, this is what really goes on behind the scenes, what really happens with these retail financial products. And it's stuff that they're not going to tell you because it's usually criminal and they would be in trouble if they did. And so you're hearing this from, these books, these different, resources and experts on here's what's actually going on here. And not only is what I'm showing you today good, but it's like you also have maybe potentially a bad situation happening in the current place your money is at. Maybe we want to get out of the bad situation and also put it in a good situation. So that's what we've got for you today, guys. Thank you so much for watching. Make sure you like, share. We'll be back again next week, and I'll see you next time. Have a good weekend.